good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at what some of the potential fortunes for the stock markets, both internationally and locally, could have in store for investors, having reviewed what would have taken place in 2022 last week. So let's get straight into it. And we're going to turn firstly to our local stock market, given some of the inputs and forecasts made by Bourse Securities Limited, as well as the prevailing market conditions and anticipated market conditions in 2023. And in a nutshell, well, for 2023, the Bourse view is that markets, or the Trinidad and Tobago Composite Index rather, is going to advance by about 5.6% over the course of the year, closing the year at an index level of 1406 or thereabouts. From its current level of 1332. We expect that the cross-listed index is going to advance just about 8.7%, with the All Trinidad and Tobago index advancing around 4.8%. And these forecasts would have been built up from individual forecasts of all of the major stocks, which comprise most of the market weighting on the Trinidad and Tobago Stock Exchange. When we take a little deeper dive into some of the major sector forecasts, we can see that banking, which accounts for over 50% of the value of the Trinidad and Tobago Stock Exchange market capitalization, is forecast to advance just about 5%, with the worst performing stock in that particular sector expected to decline just about 1%, and the best performing stock advancing about 11%. Conglomerates, on the other hand, seems to be fairly attractive from an investor perspective, with the worst performing stock in that particular sector advancing 12%, the best performer 17%, and the sector average is expected to advance just about 15%. Non-banking finance, which includes names such as Guardian Holdings Limited and GMMB Group Limited, to name a few, are expected to advance 4% on average, with an 18% advance being the best forecast performance, and a negative 5% being the worst forecast. And manufacturing and trading overall expected a marginal decline, with some of those inflationary pressures weighing on operating margins in this particular sector. The best performing stock is forecast to advance 6% and a negative 14% price change for the worst performing stock in this particular segment. Now, most of the market drivers for 2023 are indeed spillover effects from 2022, and some of those on the positive macroeconomic side include economic recovery and reopening, and more activity in the economy in general. That is also going to be supported by an energy sector recovery in terms of modest energy production gains over the course of 2023, particularly in the natural gas space. On the downside, well, inflationary pressures are expected to persist, certainly within the first half of the year. And that could continue as the cost of living continues to rise, with increases to factors such as increases in utility rates and other tariffs are expected over the course of 2023. At the stock-specific level, acquisition activity, perhaps by some of those more active companies that are in acquisition mode, will be expected to be positive for those particular companies and the sectors and index overall, as well as those companies with geographic diversification initiatives or already built-in diversification, which should augur well for those companies in the year ahead. Turning quickly to the U.S. equity market, well, median analyst estimates expect the S&P to close at a level of around 4,700, which would take it roughly, well, just over 20% up from current levels, or year-end levels rather. These forecasts seem somewhat rosy given the heightened level of uncertainty, but some of those international market drivers would include continued economic reopening, particularly with China starting to roll back some of its COVID-19 restrictions and get its economy going again. Supply chain constraints are expected to ease as we head into the new year, deeper and deeper into 2023. Inflationary pressures, of course, like the domestic economy, can weigh on consumer demand and consumer disposable income at a global level, which isn't necessarily a positive thing. Monetary policy changes are also expected to create some level of heightened uncertainty, so that could create some volatility across international equity markets, in particular U.S. equity markets. And with monetary policy focused right now on price stability, that could throw the U.S. economy into a recession, at least for a short period of time, and indeed a wider global recession. And that could create the prospect of rising unemployment. However, stick a pin here because job growth in the U.S. and job demand, or job supply rather, is in fairly high in fairly good shape for the time being. Now, how should investors position their equity portfolios in the year ahead? Well, when we take a look at some of those equity investment themes at the local level, a value bias is always a very useful approach. So look for those stocks which would give you, as the investor, a very low price to earnings multiple, perhaps a high dividend yield, and certainly industry leaders in their particular industry slash sector. And also we would favor a stock selection approach, as there seems to be some level of disparity between the best performers and worst performers on a forecast basis, at least through the Bourse view. Look for companies with built-in diversification benefits by geographical market or business segments. And of course, as mentioned, several companies have been on an acquisition drive. So you can probably keep following some of those names for accretive acquisitions, which will increase their earnings per share and increase their overall value to the investor. At the international level, maintaining a core satellite strategy for 2023 is a useful approach, the core being a broad market exposure through ETF or exchange-traded ETF or mutual fund. And on the satellite side of things, you can look at industry leaders or blue chip stocks, which are, again, dominant in their particular industries and have a significant market share. And of course, by quality, not hype, which is somewhat similar to the value bias explained in the local segments, where you are looking for stocks that give you a very reasonable price to earnings ratio and probably an attractive dividend yield. But that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, and you can check out all of our research for free at our website, bourseinvestment.com. Have yourselves a very safe and productive investing week. This has been the Bourse Report.